So this is our first session in the Markets and Macro series. That's a series we have planned to kind of launch on a frequent basis now to keep everyone updated about what's happening with global markets and what's the macroeconomic environment at this point of time. How do we look at that? What will we do in this series? We'll try and cover a few things. One, we will try and look at what's the global backdrop like, what's really happening in markets to keep all of us updated about the markets, how they are behaving, what's the key drivers of the markets, why are they behaving in a certain way, and so on and so forth. We will also look at some macro events that are happening around us, try to make sense of why those are happening, how those are happening, and what kind of impact do they have on the markets. As someone who would want to build a career in finance, it's imperative that we're able to draw linkages between what's happening on the macro side and what's happening with the market side. They may not always correlate on a day-to-day basis, but at least give indications in terms of what's really driving asset prices that's happening in the world. So it's an endeavor to kind of help everyone stay abreast about market conditions and generally be aware about developments in the financial services and market segment, right? Quick disclaimer, all the data that we're using is from publicly available sources. This is not a recommendation to buy or sell any securities or asset classes, so please don't do that. This is purely for educational purpose and understanding with respect to what's happening with the markets, right? So please don't treat this recommendation or this as a recommendation to buy or sell any kind of securities. That's broadly it. And the veracity of the information that we've picked up from various websites has not been independently verified. We're relying on the accurateness of what the reports would be, right? So that's one part. People who are joining this for the first time, just a quick introduction about FinShiksha. FinShiksha is a firm that specializes in education in the financial services domain, specifically in the capital market segment. We're not just pure education providers. We kind of help people build a career. We work with people during the entire career building phase, and our programs help kind of identifying the strengths of candidates and sharpening them, at the same time spotting any weaknesses and working towards them. Most of our courses are extremely practical in nature. They have a project embedded into those, so that enables people to kind of work. We have engaged with more than 40,000 people over the last few years. We have a YouTube channel that has lots of videos. We have a reach across the top 100 campuses in India, and have conducted more than 500 such sessions and webinars across corporates and B schools and open sessions in the last 5 years, right? That's me. So my name is Piyush. I run FinShiksha. I have about 15 years of experience in financial services, a bit more than that now. As a career, I have worked in equity research and fund management. Before that, an MBA and an engineer. And bulk of my interest area lies in the capital markets, equity markets, derivatives markets, and macroeconomic segments, right? My LinkedIn profile is available should you want to connect. Let's continue with our session and let's try and talk about the topics today. So today's topic talks about India's fiscal policy at this point, what's happening at the budget level in India, and why are we seeing the prices where we are seeing those. And then we will try and kind of understand what exactly lies ahead in terms of our overall context. So as we said, in these sessions, we'll try and understand a little bit of the concepts. We'll try and understand a little bit of the scenario and then try and link all of that together. So let's quickly understand the fiscal policy first, right? So what do we mean by the fiscal policy of the government? So just a very quick understanding, the fiscal framework of the government basically looks at revenue versus expenditure. If me or you build a budget, it would typically be income minus expenses equal to savings, right? But when the government builds the budget, the purpose of the government is not to kind of create savings. The purpose of the government is to basically ensure that enough spending happens, right? So the government actually builds it the other way around. They find out what's the expenditure, then they find out what are the revenues that the government has, and based on that they find out if there is a deficit, then that has to be funded through borrowings, right? If the expenditure is 110 and revenue is 100, then you will have a borrowing of 10. That's what is commonly called as the fiscal deficit. The term that we keep using, that's called the fiscal deficit, right? Let's say what happens if the revenue is, if expenditure is 100, but revenue is 110, right? That's a fiscal surplus. Usually in these cases, either the government will cut taxes to take revenue down or increase expenditure to kind of take it off to 110. So a surplus condition wouldn't really stay for too long in a broader environment, unless there's no avenue for the government to basically use that money. So that's in a nutshell the broad contour of how the government spends. Within expenditure, there are two headers which are there. There is revenue expenditure and there is capital expenditure, right? Revenue expenditure. So let's talk about capital expenditure first. Capital expenditure is anything that brings or builds an asset for the government, right? So if the government invests in infrastructure, if the government kind of builds a port, all of that is capital expenditure. Revenue expenditure is everything else: subsidies, pensions, interest payments, all of that goes in revenue expenditure essentially, right? Now let's understand very quickly where we stand with respect to our numbers. If I go back a couple of slides and look at the revenue sources for the government, there are two broad sources. One is the taxation sources. Tax can be direct, tax can be indirect. Direct tax is tax that is levied on essentially income. So income tax and corporate tax are both direct taxes. Indirect tax, you could look at it as being levied on transactions. So GST is indirect tax, right? The revenue could also be coming from some other avenues. For example, the revenue could come from disinvestment, right? Or dividends that a PSU entity is paying to the government. So that could create the revenue as well, right? So there are various sources of revenues. Let's look at what the government had planned in the budget, right? So when we look at the budget scenario, I'll just quickly explain some of these numbers. Don't need to remember these numbers. The movement in the numbers is what we are more worried about, right? Right at the bottom of the screen, you will see the GDP number. So nominal GDP of India is about $2.9 trillion. That's mentioned here. And 2 crore, that's mentioned in the column before that. If you look at the numbers, the top part of the numbers are basically your receipts. This is the money coming into the government. The bottom part is expenditure, and the difference is fiscal deficit, right? Let's understand the numbers a little bit. For the ease of our understanding, I'm going to talk about the numbers in these lakh crore numbers and also showcase that, what happens when they get converted to billions. So FY20 on Feb 1st, when we did the budget calculation, the estimates for financial year 2020 were revised. The total tax collection net to the center was expected to be 15 lakh crore. I'll explain the breakup of this in a minute. Non-tax revenue, which includes all your dividends, etc., was expected to be about 3 lakh crore, combining to 18.5 lakh crore. In capital receipts, you had recovery of loans and other receipts. Other receipts is nothing but disinvestment proceeds, right? So that was expected to be 65,000 crore. You add 1, 2, 3, and 4, you find the total receipts that the government is going to get. That's this number, this plus these two, correct? Now, if you look at expenditure, capital expenditure is the one that we are doing on asset creation. Revenue expenditure is everything else. You put those together, you get about 26 lakh crore kind of a number that we get with respect to the government data, right? 26 lakh 98,000 crore is the number that we are getting here, right? Now, out of this, so there's some rounding error, that's okay. The difference between this and 1, 2, 3, 4 added is my deficit. That's 7,66,000 crore. When I convert it to $1 billion, $110 billion as a percentage of GDP, 3.8% was what was estimated last year. There was obviously a projection for FY21. I will leave that out for the time being. We will come back to that in a minute, right? Now, after the year, somewhere in the month of May or June, you come up with provisional estimates for last year, right? This is now the actual number. This is the actual number that comes out. So in Feb 1st, when we did the budget calculations, we gave a revised estimate of what is going to happen. Now we gave the provisional numbers. The provisional numbers fell short on almost all counts. So tax revenue was lower, non-tax revenue was lower, disinvestment was lower. Consequently, and expenditure was equivalent, so that was the same number. So your fiscal deficit number and the borrowings number went up. So whatever is the deficit between your income and expenditure, that's basically going to be funded by borrowings. There's no other way. You have to borrow that money, and then you have to spend that money in terms of wherever you're spending it, right? So that fiscal deficit number actually ballooned to 9.3 lakh crores, and that became 4.6% of the GDP. That's not the entire story though. That was known because, in the months of Feb and March, the problem had started kind of coming in, and consequently what happened was the numbers started going down. Anyway, we were in a slowing economy, and then, coronavirus hit, so that kind of created a bigger problem. Tax numbers went down. I'll dig deeper into tax numbers in a bit. What that did is FY21 estimates became too far, right? Too far high in the sort of growth expectation that you have. Now, from the actual number that came out, if you were to look at the numbers, you're expecting, if you have to meet this target, you're expecting a growth of 21% in the tax revenue, 18% in the non-tax revenue. Disinvestment, last year we did 50,000 crore. Next year we're expecting 2,10,000 crore because we are anticipating the LIC IPO to happen. Whether it happens, doesn't happen, we don't know. So that's an expectation of 317%. If all of this happens and GDP grows at 10% nominal terms, right? So real plus inflation 10%, then we get a fiscal deficit of 3.5%. But that's unlikely to happen for a variety of reasons. What's likely to happen is we are going to see a degrowth of 10% as we stand today. Of course, these numbers are subject to change, and there's a possibility that we are looking at. So these are my estimates that I've put in here. If you see a 10% degrowth over 13.5 lakh crore, your tax revenue goes to 12.2 lakh crore. Probably some jump here. I'm assuming a 1 lakh crore kind of a revenue from disinvestment. Your revenue expenditure will probably be higher because the government will have to kind of fund this entire bailout package that they are doing, right? In fact, it could end up being higher. Assuming a nominal growth in capital expenditure, and assuming still that our GDP finally ends up growing at 5% nominal terms, we would still have a fiscal deficit of 6.1%. My sense is we are probably a bit conservative with the problems that could come in terms of taxation collections. So we have to look at that carefully in terms of where those numbers are coming in, right? Let's understand the tax numbers a little bit. So if you go back a couple of slides and you look at the estimate that was given, this was 15.04 lakh crore, right? This is the same number that you see here right at the bottom of this column, correct? Now, when the center collects taxes, it collects a gross tax, and then something goes to states. Whatever goes to states, you basically then are left with the center share of revenue, correct? That's 15 lakh crore. Your tax collection was expected to be 21 lakh crore. Out of this 21.6 lakh crore, you were expecting nearly half, 6 plus 5, right? So 6.1 lakh crore was expected to be corporate tax, and 5.6 lakh crore was expected to be income tax. This adds up to 11.7, which is direct tax, correct? This was the revised estimate there. And then of course, from there, you came up with the other estimate that was in terms of what kind of growth you're going to see. So that assumes approximately close to a 12-13% growth here and probably about a 15% growth here from the revised estimate. What happened in actual numbers? This 11.7 came out at 10.3 lakh crore. Eventually, the final number that came at the end of March was 10.3 lakh crore. So you had a substantial shortfall already in the income that comes in, right? If you look at this carefully, there is this provision for excise duty, right? Where is this excise duty coming from? Primarily on account of fuel, right? Now let's see what's happening right now. Direct tax collections for last year ended up at 10.27 lakh crore versus revised target of 11.7 lakh crore. That's what we just saw, right? So in our estimate, when we added those two numbers on the previous slide, 6.1 lakh crore and 5.6, that's 11.7. Instead of this, we got 10.3, correct? So direct tax ends at 10.3 lakh crore, and that's the first problem, that you have a shortfall. you are likely to see a further shortfall here. Why does that come? Because your April to June quarter numbers also show a 30% dip. In numbers including advanced tax and TDS, you are showing a 30% dip in the collections of direct tax, right? So your tax collected until 15 June stood at 92,000 crore as against 1.37 lakh crore, so dropped by over a third. So you are not only going to see, we already saw a dip to 10.3, it's likely that we are going to see a further dip. Not too difficult to imagine, right? If you assume a company has revenues of 100 and costs of 80, you are going to pay taxes on 20, right? That's the revenue, that's the cost. So you're going to pay taxes on 20, assuming 25% tax, 5 goes to 15, right? Now, if one quarter gets washed out completely, more or less, your revenue actually goes to 75. And it might not even be 75 if we don't see a recovery pretty soon in this quarter, right? Costs will not go down dramatically. I mean, costs could be fixed in nature to a large extent. So if you actually don't see costs going down, even if I assume a slight marginal reduction in costs, your profit goes to 5. Tax on this is going to be probably 0.75. That's a huge reduction on corporate tax for certain companies. If certain companies face this, obviously corporate tax is going to dip next year. If corporate tax is going to dip, salaries are not going to increase, income tax is also going to dip next year. So there is no way this number is going to grow as we stand, right? I'm assuming a 10% dip. That 10% dip relies heavily on the fact that the dip could actually be larger in the direct tax numbers, but it relies heavily on the fact that your fuel tax collection will probably add about plus 1.5 lakh crores if you continue keeping fiscal, the excise duties at the levels they are. So we get this question as to why are tax rates so high on fuel prices. That's primarily because the government doesn't have the money and they are not seeing any visibility of revenue coming either on corporate tax or on income tax. GST numbers are going to be on transactions, and if everyone is sitting at their home, how are transactions going to come in? So consequently, you have to make money somewhere. You can't just go all out and keep borrowing everything that you need, right? Because the fiscal deficit numbers could be pretty large this year. We've been hovering in between 3.5% for the past few years. It is quite possible we end up with 7% kind of a number this year, right? Now you can borrow your way out of it, but if this continues for a little bit of a while, there is going to be a little bit of a problem. So the government is trying to basically get taxes where they can. We will not get into whether it is right or wrong. I don't think they have an option at this point of time. And that's probably why they are saying that, okay, if excise duty is high, it's high, that's okay, let's keep excise duty high, because that's the only area in India where you get tax collection at source, right? Income tax, etc. If you increase the burden on income tax levels or corporate tax levels, you are going to essentially A, hurt the consumers, B, you are going to also hurt people who are compliant, which is not the generic idea that you want to do. So you'll probably take it up to a point where you put a tax on any kind of transaction. Fuel is the biggest transacted commodity, so you put a tax on that. That's probably the idea behind it. We don't know what holds ahead, but that explains the desperation to keep fuel tax high at this point of time, despite a lot of opposition, purely because I don't think they have any other option at this point, right? So that's basically where we are. Right. There are, of course, other things they can do in terms of borrowing. The government obviously does a little bit of borrowing off their balance sheet. So, if you look at the borrowing here, you're expecting a total borrowing of about 13 lakh crore. You could actually look at borrowing some of it off your balance sheet. So maybe an NHAI can go and borrow on your behalf and put that money in capital expenditure in a road project, right? That's not a very healthy way of doing things, but they've been doing that anyways in the last few years, right? It's not like they were not doing it. If you add all of that, our deficit was anyway higher. Now we are looking at an even bigger number if things don't materialize. And that's probably why we did not get a very large bailout package as compared to some of the other economies globally, because we don't have the resources to tackle that kind of a movement, right? So that's in a nutshell what's happening with our fiscal environment. It seems very, very evident that we are going to see a dip in taxes, tax collections, right? It is evident or fairly likely that disinvestment, disinvestment is going to be fluid. We don't know what's going to happen there, and expenses are going to be higher. Just recently, the government announced continuing the food grain package for another 5 months. So that's another 90,000 crore added straight away, right? Where do you get this money from, right? If you keep borrowing it, you run the risk of getting downgraded on a lot of the global parameters. So that's sort of the bad news that we see at this point of time in terms of the economy. There's no easy way out of it, unfortunately or fortunately. We have to live through this, and till the time the economy goes back up on steam, we will have to look at the numbers as they are. This is where numbers are. Of course, we can discuss and debate further in terms of what can be done around it. We'll take that in a separate session at some point, right? Let's move ahead and talk about what our market's telling us, right? So far we were looking at economic data, and that's probably unequivocally bad, but financial markets have their own mind, and usually markets actually are leading indicators. They kind of talk about 1.5 years down the line or 1 year down the line. Markets can be wrong as well. They were pretty wrong in February. They were not anticipating what could happen in coronavirus, and when they realized, they just reacted heavily in the month of March, right? But since then, the performance has been interesting post March. So what are global markets telling us? On the left, you see S&P 500 index. It fell from about 3,400 levels, went all the way down to about 2,200 levels, is now at 3,130, right? So recovered most of the lost ground, to be honest. If you started the year here and you were standing here, and someone had told you that you're going to see a big global pandemic and still the market would be off only about 10%, I think most of us would have laughed that off. But that's precisely what has happened. The same is the case with German DAX, which fell actually much heavily from about close to 14,000 kind of levels all the way down to 8,000, but again has regained most of the ground, right? Now, that's interesting, but that's not the entire story. The story gets even more interesting as the technology sector comes in. If you look at NASDAQ, which is the tech sector index, that's actually at an all-time high. It went down and then it went up, right? It's now actually above the levels that it was trading in February. And if we were starting at the beginning of the year, somewhere in January, NASDAQ was at 9,000, 9,200. If someone had told us that there is going to be coronavirus and then still we'll be up 10% on the NASDAQ at the end of this, we would probably have fallen off our chairs, right? So that's the story of technology sector taking over. That's the story of all these stocks, basically the likes of Facebook, Amazon, Netflix, Zoom, kind of just going through the roof. As the initial issue happened, stocks corrected, but then probably because of digitization, probably because people realize that these are going to be massive beneficiaries of the entire scenario, almost all the stocks went up, right? If you look at Zoom's chart, for example, that has gone up dramatically fast. So technology sector has driven this entire game upwards. Financials have actually been underperforming world over. Banks have not really done well either in India or in US. Even the S&P's performance is heavily driven by the top heavyweights, which are all your index players. A fun fact would be to actually kind of add the market cap of Amazon and Microsoft, right? Amazon, Microsoft, Apple. If you take any two of these three and add the market cap of these stocks, any two of these three, the total market cap is bigger than India's total market cap. All companies listed in India. And of course, there's a reason for that. Google also comes there. So you add all of these, they are like astoundingly big tech companies which are growing at breakneck speed, and the market is giving them their fair share of due in that regards. Is it a bubble? We don't know, because typically, obviously at some point it will become a bubble. But at this point, it just doesn't look like stopping. Indian markets have also kind of recovered a fair bit. We went all the way from 12,400 to 7,500 on the Nifty. Now ended today around 10,600. Retraced more than 50% of our fall. We have actually lagged. Most emerging markets have actually not done as well as the developed markets. Probably a little bit to do with the fact that the European region and US were affected by the pandemic before some of these markets, so they came out of it earlier as well, or they are coming out of it earlier as well as we speak. So what explains this entire scenario in terms of this divergence between what's happening in markets and what's happening in the economy? When you look at economic numbers, on ground activity has not picked up. I mean, in India, there are sort of job losses, there are jobs which are going away globally as well. You keep reading about bailout packages globally. You keep reading about the fact that companies are not able to kind of, there's this open and shut kind of thing that is going on. You start something, then you find cases, you close it down again. Half the country is in lockdowns, and we don't really know when it is going to open up. People are not going out, people are not spending as much as they were earlier, but markets don't seem to be caring about it. So what is causing this? In fact, in India, we have a tech version of all these tech companies. The closest we come is Reliance Industries. And somewhere in this pandemic, Reliance basically turned itself from being an oil company to a tech company. Or at least the perception kind of became an oil company to oil plus tech company or data company. All these investments came in, effectively putting it up like a tech company now. And Reliance trades at a market cap of $150 billion. Some of these larger companies trade at $1.5 trillion, right? Now, or 1.4 or $1.2 trillion kind of numbers. So huge sort of gap that exists, and the size and scale of Reliance and the very fact that Reliance has been able to kind of mop up this kind of liquidity in a pandemic-led shutdown is absolutely remarkable, which is probably what the market is rewarding it with. Right, so we might see some of this as well, that Indian markets are being driven more by the tech proxy players, which includes Reliance at this point of time. We don't really have an Amazon or a Facebook kind of an entity at this point of time. The closest we are getting is Reliance, and probably some internet companies which are listed, which have also done well, to be honest. Right? What is causing all this? So let's quickly try and put our hand on that. Liquidity injection by central banks is a big reason. Almost all central banks have thrown money at the problem, buying bonds, buying asset classes, saying that anything that happens to stock markets or any kind of markets, the central banks step in and say, okay, we are here to save you. And that basically has led into this belief that whatever happens, the central bank is going to exist, and that's going to kind of be there. And that could result in complacency. We don't know what lies ahead, but one part of the big chunk is that there's enough liquidity. There's huge amount of liquidity that exists here, right? There is a likely resumption of the economy across the world. There is a resumption that's taking over. Economies are opening up. Europe is opening up significantly. Cases are on a decline in Europe. US sees a second round of spike. That kind of puts it at a divergence with Europe, because Europe hasn't seen a second round of spike, interestingly, as yet, and Europe got affected earlier. So if you go by what's happening in Europe, you would probably say that in a month or so, probably the things will settle down in US as well. We know that technology sector has taken over. But the interesting part is that the numbers on the virus are becoming worse in the US and definitely becoming worse in India. They're likely to become worse in India as well, right? However, unlike February, the problem is known now. The markets know that coronavirus exists, right? The markets know that there is going to be a long way out of this. There is going to be a risk of a certain amount of fatalities across countries and networks. So it's known now, right? So unless the news potentially becomes really, really worse, right, which means your assumptions on fatalities go out of the window, and there are new assumptions coming in there, or our assumptions of what lies ahead for someone who has been affected by coronavirus but has recovered, does that still create a problem? We don't know. But at this point of time, just looking at how markets are behaving, it seems that the market has already priced in the worst with respect to virus numbers. Numbers will have to get seriously worse from here for the markets to start paying too much attention to it. I mean, I'm not saying about a 5, 7, 10% kind of a move in the markets, but if we are expecting a repeat of what happened in March, I think the market will need to see really, really bad numbers on the virus thing. I don't think we will get there personally, right? Hopefully we should be out of worsening numbers in a couple of months globally, and that should start resolving things a little bit as we go along. Could the economic numbers that come over the next 6 months spook markets? Absolutely. We don't know about that. That could be a problem because, immediately after the, this aftermath of this entire rally that has happened in asset classes, you could see a scenario where people realize that, we thought things were improving, but on ground, it didn't really improve because consumption patterns changed fundamentally for certain sectors. If that happens, we'll know about it in the next couple of months or so. As you start getting those numbers in, you could start getting reality checks from time to time on financial numbers and financial markets. So I don't know whether this is going to be a runaway rally and we have seen the worst behind us. It doesn't look like, you can have a complete V-shaped recovery, but some of the markets are showing an indication that, they weren't really affected, and probably tech sector wasn't really affected as much, but other sectors could still see a long road ahead in terms of the eventual recovery. This could be now a long drawn process in terms of how markets react over a period of time. We'll discuss a little bit more about various sectors over a period of time as we go along. That's broadly it in this particular session from me.